Good day, Zach McReynolds here of the Cherrie Brown and Zach McReynolds team at HomeSmart Santa Clarita, California. Today I'd like to take a minute and talk about first-time home buyers. It does make up a large percentage of the home buyers out there, as well as a lot of our clients are first-time home buyers, and these are some of the things that we end up having questions from them about, or at least discussing when we're prepping them to get prepared for purchasing their first home. Let's just call them guidelines, maybe a little bit of a checklist you can go down to make sure these are things that you're taking into consideration as you're preparing to make your first purchase. First and foremost, down payment. Have you been saving money? Do you have 3%, 5%, 20%? There are different loan programs available where different down payments are allowed, and then your loan will be the balance of the purchase price of the home minus the down payment. The good news is you are allowed to get gift funds from, say, family members. So, let's say you're pretty close to having 20% saved up, but you need a couple $1,000s. You can receive that as a gift to put the 20% down, because if you're putting 20% down, then you are avoiding PMI or mortgage insurance, which can run up to, quite a few $100s more a month on top of your property taxes and your mortgage payment. Of course, we need to consider your credit rating. Do you have any issues? Have you had any issues in the past? Is this something that we're working towards? Your interest rate will be based on your credit rating. So if there's some minor adjustments we can make to your credit score to kind of get you into a better interest rate, that's something that we'll want to consider going forward. Do you need credit repair? We have a great guy that will take care of you. I've actually used it myself, and it does get results if that's an issue. It's manageable. Debt to income ratio or DTI. This is a lender term that they're going to talk about. They're not going to be able to lend you money more than a certain ratio of what your monthly income is. So, if you make $5,000 a month, you're not going to be able to purchase a home where your mortgage payment is $4,000 a month. There's a ratio that will fall into some sort of guideline as per the lender, the company that's going to give you the loan for your house. They have a ratio of where that payment is allowed to be in relation or ratio to your monthly income level. So that's called debt to income level, or DTI for short. Your monthly payment, of course, this is usually a good place to start when talking with a lender, is where is your comfort level? What do you want to spend? You may approve for $4,000 a month, but you may not want to spend more than $2,500 a month. So yes, a lender may say, hey, you approve for $1 million home, but that may not be realistic or within your comfort zone of where you want to be at as far as your monthly payment. You may end up wanting to be at only a $400,000 home. Obviously, home owning versus renting. This may be something that you're already thinking about in your head. You've been renting for a few years. You're throwing money away just because there's tax ramifications as far as write-offs when you do own a home. So, if you weigh it on a scale, there are benefits to owning versus renting, especially when we're in an up market like this. It's an investment on top of the tax breaks and whatnot. So just something to consider there as well. The loan programs, already talked about this a little bit in the beginning, but there's 3% down, 5% down, 20% down, 10% down. All these are going to affect your monthly payment, as well as possible PMI, like we discussed a moment ago. Mello-Roos, of course, here in Santa Clarita Valley. I know that this is in other cities across the nation, but in Santa Clarita Valley, we do have quite a few communities that have Mello-Roos. This is an additional tax on top of your property tax, on top of your payment, on top of your HOA. It's an extra fee that, depending on which neighborhood you live in, they go to different amenities, I guess we'll call them, in the neighborhoods. It could be parks, it could be fire stations, it could be schools, but there is an additional tax in certain neighborhoods that go to these areas. So being aware of them, you may see a home that looks, brand new, built in 2010, looks amazing, and it's only $289,000. Well, it could possibly have a Mello-Roos tax on top of it. Some of them in the area range as high as $400 or $500. So just something to keep into consideration there. There are other things you'll want to keep in mind too that may not be as high on the priority level, but things you'll obviously want to consider. School districts, shopping proximity, freeway access. Do you commute to the Valley or LA or Burbank? Certain areas in Santa Clarita could be 10, 15 minutes just to get onto the freeway in the morning. So do you want to be next to the 14? Do you want to be next to the 5? Neighborhood amenities, we don't always think about this in the beginning, but do you need a community pool if your home doesn't have one? Do you need local parks and the paseos and all these awesome things that make up awesome town? And at the very end, priority 1, 2, and 3, of course, location, location, location. So if it works for you and it works for your needs, then it works for the situation, but you've got to take that into consideration, that location is obviously important. Thank you so much for watching. Of course, if you have any questions, you can call me directly, 661-262-9224, or you can email me, which I'm sure is around me somewhere, my email address. Thank you again for watching. Have a great day.